at. But on that note, let me bring on board our next guest for today. Joining me is big market voice, big market expert, Sunil Subramaniam. Sunil, lovely to be chatting with you once again. Last time we spoke, I think we were, just about starting to see recovery take shape. Now we are back near the 24,500 mark, and FIIs have also returned. But tell me something, we have the border tensions escalating, geopolitical tensions, at the center stage. Even then, FIIs continue to pump in money into the Indian markets. Do you think it's the TINA factor? There is no alternative factor that is driving FII flows. What is it? Because recovery across global markets is also taking shape with S&P, just last Friday clocking in a 9-day winning streak. It's best in 2 decades.
So I think that first of all, there's a positive move towards equities. As you said, the American markets are also showing a recovery, and FIIs are increasingly willing to take up risk and bet on equities. So that's the overarching thing that we are seeing. And what's the reason for that? I think the reason for that is the pragmatism which has come about in the Trump policies on the tariffs, the way. So if you see now, we are now near the end of the tunnel in terms of at least non-China getting a clarity on the tariff scenario, how it will affect both the US economy and corporates in the US as well as on the suppliers, right? So I think Mr. Scott, who's the trade secretary there, mentioned that they are close. At least a dozen countries have reached out and are in advanced stages of signing a deal. And Mr. Trump himself mentioned India, so coming to India there. So I think that once they see the clarity, right, wherever it ends, as long as there's an agreement between a country and America on that, to that extent, there is a way forward. So I think the markets are pricing in that. The India factor, you mentioned it as a TINA factor. So I would say that, look at it this way. The TINA tends to be as if they have no other choice in terms of negatives, and this is India's the best hope. I'm not sure it's that. The word TINA tends to refer to that. So I would like to say that actually the situation is emerging very positively for India. So it's actually an active choice for them to choose India, and I'll lay out the reasons for that. I think top and center of everything, right, is the oil price fall. And I think with Saudi Arabia indicating even more production increases, and I'm reading articles about how it could slip below 50. It's not yet, the futures are not yet indicating that.
Yeah.
But I'm just saying that overall is an overarching thing for short-term FIIs to come in, right? I don't think longer-term FIIs have ever had an issue about India's growth. All that is not new news. The second aspect I would say is that on a sequential basis, right, if you see the GST collections, right, in India coming out stronger, 12% stronger compared to the same period last year, indicates that the economy is recovering from the lows it saw in the Q3 and Q4 of last year. So, which means that you're now buying into a rising economy. The market earnings are still mixed, but sequentially, I'll tell you where the issue is. If it's sequentially improving, it means that you're going to see the future quarters come in better. So I think that's the second take for India is concerned, that the domestic economy. And the third is, I think, a supportive RBI policy has made it very, very attractive. The reason being that there's 5 lakh crores of liquidity the RBI has pumped in, there are 2 rate cuts and possibility of a third. And on top of it, you have inflation supporting this factor. So if you have a supportive RBI policy, then the FIIs are reading into the fact that domestic equity investors will probably start allocating more. Actually, if you see, DIIs are still sitting on the fence because they are waiting to see the earnings season fully play out. So there's still cash in the bank for the DIIs who can come in. So FIIs are probably looking at it and saying, if these things play out, the DIIs come in, then the prices could go a bit higher. And if you see India's valuations there, a long-term average premium to the emerging markets is about 60-63%. We are trading today at 75%, but we were at 90, close to 100% a few months ago. So I think that we are that space where we are not cheap, but we are round about the long-term average. And they are now sensing that India may not get cheaper because domestic money will start flowing in and maybe takes prices higher. So might as well buy into a market we intend to be invested in a bit early, though the valuations don't truly justify. Now, coming to the effect of the Indo-Pak situation that you mentioned, why are not FIIs worried about it? It's because two things are there, right? I think the government has demonstrated a very diplomatic pragmatic approach to handling the crisis. Well, there's been a lot of talk about aggressive action and all. The government has restricted itself to building a good diplomatic thing with talking to the UN, talking to the US, talking to Europe, and everybody trying to build a consensus around it. Second, they're acting economically, right? Even going to the UN to try and see if UN can do something. So I think the way it's being handled, as long as it's not a full-fledged direct upfront war, right? The FIs will be relieved because they know that there's too much at stake for India in this emerging situation, right? So we want to actually give employment to our people. We have the largest amount of workforce waiting to be employed. We have far greater challenges to decide on, to take action, and trying to be doing a BTA with the US, and all these are probably top of the agenda. So they are sensing that India is going to handle this in a balanced, mature manner. Yes, there will need to be strong action. The government will do that. But what they are saying is that if that happens, it's still something that will be quick and dirty. It could be a surgical strike. It could be a attack of the type that the Balakot they did. They just go in and come out. It'll be something to demonstrate that India will not take this lying down, but not a prolonged war like the Israel-Hamas war or the Russia-Ukraine war. They don't see that happening in India. So as long as that's a short-term thing, they feel that they can take it in their stride. In fact, if there is a correction because of such an event, FI buying would step up even more because they're getting India cheaper. So I think that they are all taking a slightly medium-term perspective that India as a nation is not run by any tin pot dictator who is going to take a knee-jerk reaction to this situation, but will take a strong, solid action, but which will be by and large within the comfort zone of the international community. At the same time, trying to find that balance that the domestic population also feels that we have acted strongly. It's a balancing act. We don't know how it's actually going to pan out, but I think the confidence that this government will pull that off is what is probably giving FIs the comfort that let's not wait for the whole uncertainty to go on. Let's start allocating gently into India.
All right, that's a very comprehensive explanation, and it puts to rest a lot of other questions that I had for you, Sunil. But let's talk about the recent Supreme Court ruling on JSW Steel in terms of the Bhushan power resolution. What kind of implications will that have going forward? Has it shaken the confidence in the entire IBC process? How are other cases being impacted, and what does it really mean for JSW Steel as a company? I want to get in your thoughts on this entire issue.
See, I'll tell you that. See, I think that one has to bear in mind that that's the democracy at play, where the judiciary has a say on this. So I think that in this tussle between a parliament which wants a strong IBC to be implemented and the judiciary which is trying to look at the rights and the wrongs, right? There will be this tussle, right? And you'll have one evidence, one decision going this way, one that way. I would not try to take this and draw a parallel to say all IBC cases are now under threat, right? I think it's all specific to the event. But I think this is the great strength of India, that you have a counter-check balance of a judiciary which is impartial and takes decisions. You may agree with the decision, not agree with the decision, different, but it strengthens the process. So tomorrow is as a decision where the Supreme Court actually, let's say, supports another IBC case. It means it's passed the test and the filter. So view these as the challenges of putting through a very hard and difficult law which is trying to resolve it, but there are these challenges that come up because we have an independent judiciary, and you have to take the good with the bad. Just because if one thing is turned down, you don't go and dump the whole thing. You don't throw out the baby with the bathwater. I think we have to look at it, resolve it. I don't want to go into company specific on this because that wouldn't be right of my part. But overall, to me, right, while this may seem like a setback for the IBC process, I don't view it as that. I think it is an important that when we take such decisions, we have to take the other points of view that a judiciary may come up with also in terms of framing it. So it's just a learning. It's part of the learning curve for us as we grow into becoming more of a developed country, that the stakeholders in this, the judiciary is a part of the stakeholders, is something to recognize. So I would like to look at it in that perspective and not simply do a knee-jerk reaction to one particular decision by the judiciary.
Fair point, Sunil. Let's talk about the earnings season then, particularly the banking pack. Of course, in terms of liquidity, the RBI has been extremely hyperactive, so to say. And in terms of earnings particularly, of course, the rate cut cycle is at play. Most of the experts are expecting another 50 basis point rate cut in the current fiscal. SBI, the big elephant, so to say, has hinted that, of course, there will be margin pressure. They've also scaled down their loan growth guidance. But, on the other hand, you see private sector players like HDFC Bank, ICICI Bank handing in great set of numbers. Kotak, on the other hand, has its own set of issues in terms of MFI stress. So, after the report cards from some of these companies, which way should one tilt? Should one stick to the private sector names? Do you think they are better equipped to deal with margin pressure as a result of rate cuts?
So I would say yes, to give a short answer, yes, but let me talk about the justification for that. So if you look at it now, you talked about how SBI had given a kind of down guidance for the future, whereas the private sector banks seem to be better placed there. So I think the reason for that comes from the fact that where do you see the whole banking system, right? And when I say banking system, let's talk about the overall BFSI system being driven over the next few weeks and months. So the first thing is that, yes, rate cuts are on the anvil. So rate cuts will mean that banks which have a lot of fixed rate loan books. Now, the housing loan book is largely variable. It's the personal loans and the auto loans, which are of the 3-year tenure, which are the fixed rate loans, which will get hurt because you will be dropping interest rates on your deposits, but you won't be able to have any effect. So the private sector banks, right, when they drop interest rates, they will still be earning the fixed rate on their personal loans and the auto loans. So the margins will be less affected because they have a greater play in the retail lending, except for the home loan part, which is variable. The rest of the retail lending by and large is fixed rate. So I would say that in the short term, the rate cut would benefit the private sector banks because they have a fixed rate loan book, and they will pass on these rate cuts in the deposits and probably have lesser impact on their margins as compared to a public sector bank, which is mostly in the corporate lending space and the housing loan space, which are variable rate, where there could be margin pressure. That's one reason to favor the private sector. The second reason for that is, where do you see the nature of the loan growth coming from, right? Like you said, SBI has slightly given a down guidance. So the issue is here that where's the loan growth going to come from is in a drop in EMIs, one. Second is the 100,000 crore of tax giveaway filtering through into the hands of the middle class consumer, right? So as his salary from April month, May month onwards, he feels the benefit of the tax cut, and an RBI rate cut comes in and reduces EMIs. The loan growth will build up, right? That's the demand side. And there again, private sector banks are much better placed to exploit that with quick turnaround, instant approvals at the consumer durable counters, whether it's a Chroma or a Reliance Retail, where you sell these products, right? The quick turnaround. So I think that they will get a better loan growth book. Yes, the fact that you are going to have to reduce EMIs means that they will have to proportionally cut the deposit rates, but definitely they cannot cut it as much. So there will be margin pressure. I'm not denying that, but I'm saying they can compensate with a faster loan growth book because it's price into quantity, right? You will have slightly lesser NIM, but your loan growth in the private sector could be better. Hence, the P into Q could turn out into an EPS growth, coming out better than guidance. That's the second part. The third part is the fact that most of the private sector banks have a very good fee-based income out of the mutual fund distribution, AIF distribution, insurance distribution piece, whereas in the public sector banks, apart from a state bank and maybe a Canara Bank and to some extent a Bank of India, none of the public sector banks are yet that big players in this whole space of distribution. So I think that of the 100,000 crores, you will see a significant proportion also go into incremental savings, which could boost the fee-based income of the private sector banks as compared to the public sector banks. So from a near-term perspective of the next 3-6 months, I do believe that private sector banks represent a better play for the time being. If you have a long enough term of an 18-24 month, I see that somewhere this consumption, which I expect to be a driver, will boost capacity utilization, and corporate capex could pick up by the end of the year, next year, which public sector banks take. So your time frame also plays a part in this, in terms of how you allocate between private sector and public.
Sure. Very, very comprehensive answer there, Sunil. But the last question really, due to paucity of time, what should a portfolio really look like at, this time? Of course, there are rising geopolitical tensions. Gold has, been hitting record highs recently. So what is the kind of portfolio construct one should have to get the best of both worlds, equities and commodities?
So I would say that if you look at it, to me, the two M's are the key play in the mutual fund space, which is multi-cap funds and multi-asset funds. Okay. Now, why do I do it this way? Is because when you take multi-asset funds, I think the regulations permit up to 20% in commodities. So I think there are AMCs which are taking full advantage and keeping 15 to 20% in commodities, and naturally gold forms a significant part. So buying it through that means that you can get the gold through an equity taxation matter. But most of these multi-asset funds, when they put into the equities part, they tend to be in the large cap side. So what you will miss out there is a broader market equity participation, but you get a good blend of equity because you'll have about 10% only in fixed income. So you'll good blend of equity and gold in the multi-asset. So by choosing then a multi-cap fund as your other portfolio, you get a minimum of 25% into small caps, 25% to mid cap, and 25% to large caps, and the balance based on the fund house can switch between the two. So if you combine these two, you will get not only a broader market equity exposure, but you will also have a good exposure to commodities in that. And I think that's the best way in the current scenario to play it. And if you're a little more conservative, then maybe you look at a balance advantage also. But I would say multi-assets itself should be able to take care of the risk reward in a better way.
All right, that's the word then. With that, Sunil, I would like to thank you for taking out time as always and joining in and sharing your thoughts with us. Love to get your perspective, and I look forward to more conversations in the coming days as well. Have a great day.
Right. Thank you. Same to you.